3 weeks ago, the European Central Bank increased its gold purchases by 47% quarter over quarter, while simultaneously announcing another round of quantitative easing. The Bank of Japan followed with a 23% increase in precious metals reserves. The Federal Reserve, for the first time since 2008, publicly discussed alternative reserve compositions in its quarterly meeting minutes. This is not coordination, this is recognition. When the institutions responsible for maintaining confidence in paper currency systems begin accumulating the assets that historically replace those systems, something fundamental has shifted. This is not a policy adjustment. This is not a diversification strategy. This is the institutional acknowledgement that the current monetary framework has reached a structural limitation. The question is not why central banks are buying gold. The question is why the guardians of fiat money are hedging against their own creation. Why are the architects of modern monetary policy simultaneously undermining confidence in their own system through their actions? This is a system signal, and it is flashing red. Every historical monetary crisis follows the same institutional pattern. First, policymakers publicly defend the system while privately preparing alternatives. The current central bank behavior mirrors this exact sequence. Public statements emphasize stability and control. Private actions reveal preparation for systemic transition. The financial media will frame this as a story about gold prices. They will discuss supply and demand dynamics, inflation hedges, and portfolio allocation strategies. They will interview analysts who will explain why precious metals are outperforming or underperforming relative to other asset classes. This framing misses the fundamental reality entirely. Precious metals do not emerge during monetary crises because they are good investments. They emerge because they are the only assets that exist outside the monetary system that is failing. When confidence in the medium of exchange deteriorates, economic actors do not seek better returns. They seek escape from the system entirely. The real question is not, why do precious metals perform well during crises? The real question is, what structural flaw in debt-based monetary systems makes periodic flight to hard assets inevitable? The answer lies in understanding money not as a tool for transactions, but as a confidence game with mathematical limits. Every fiat currency system operates on the assumption that economic growth will permanently exceed debt service requirements. This assumption has never proven sustainable across extended time periods. Modern monetary theory attempts to circumvent this limitation through coordinated global policy and technological advancement. The theory assumes that digital systems and international cooperation can transcend the mathematical constraints that destroyed previous monetary arrangements. Current central bank behavior suggests institutional recognition that this assumption is failing. Throughout recorded history, the same sequence repeats with mechanical precision. The pattern transcends geography, culture, and technology because it is rooted in the mathematical impossibility of infinite debt expansion within finite economic systems. Emperor Nero began debasing the denarius to fund military campaigns and public works. The silver content dropped from 83% to 55% over 14 years. As the currency lost credibility, Roman citizens began hoarding silver and gold coins minted before the debasement began. Archaeological evidence shows massive caches of pre-debasement precious metals buried during this period. The Roman state responded by criminalizing the hoarding of precious metals and implementing price controls. Citizens found guilty of precious metals speculation faced exile or execution. The policies accelerated the crisis rather than containing it. The economic system destabilized further. Trade shifted to barter systems using actual silver and gold weight rather than official currency denomination. The monetary crisis preceded the political collapse by decades. Historical records show that confidence in Roman currency had evaporated throughout the empire long before military defeats and territorial losses became apparent. The economic foundation of imperial authority had eroded through currency debasement, creating political instability that military power could not restore. The German government, faced with war reparations exceeding its fiscal capacity, chose monetary expansion over economic contraction. The Reichsbank increased the money supply by 15,000% between 1919 and 1923. As the mark's purchasing power deteriorated, German citizens converted savings into foreign currency and precious metals. Gold and silver became parallel currencies, while the official mark became a medium for immediate transactions only. Shopkeepers accepted marks for daily purchases, but demanded precious metals for durable goods or storage of value. The dual currency system persisted until complete monetary collapse in November 1923. The Weimar government declared precious metals speculation illegal and required citizens to surrender gold and silver holdings to the state at official rates. Citizens who complied lost their savings when the mark became worthless. Citizens who violated the law and retained precious metals preserved purchasing power through the crisis. The policy failed because the underlying monetary problem, debt obligations exceeding productive capacity, remained unresolved. The flight to hard assets accelerated, contributing to complete monetary collapse and the political instability that followed. Britain abandoned the gold standard in September 1931 after persistent pressure on sterling reserves. The Bank of England had attempted to maintain gold convertibility through interest rate increases and deflationary policies. These measures preserved currency strength but contracted economic activity, creating unemployment and political unrest. When the government chose economic recovery over currency stability, confidence in sterling collapsed internationally. British citizens and foreign holders of sterling bonds began converting to gold and other hard assets. The Bank of England's gold reserves fell by 60% in the 8 weeks preceding abandonment of the gold standard. After abandonment, the pound depreciated by 25% against gold within 6 months. Citizens who had converted to precious metals before abandonment preserved purchasing power. Citizens who retained sterling-denominated assets experienced significant wealth destruction. All three examples follow an identical progression: excessive debt obligations, monetary expansion, credibility loss, flight to alternatives, state attempts to control the flight, system breakdown. The current global monetary system exhibits every characteristic present in historical precedents, but at unprecedented scale and coordination. Central bank balance sheets have expanded by $15 trillion since 2008. Government debt to GDP ratios in developed economies average 107%, exceeding sustainable levels by any historical measure. The difference is synchronization. Previous monetary crises were localized. When Rome debased its currency, citizens could flee to Greek or Egyptian alternatives. When Weimar printed marks, Germans could hold dollars or pounds. When Britain abandoned gold, investors could shift to American or French securities. Today, all major currencies are simultaneously debt-based and simultaneously expanding their monetary base. The Federal Reserve, European Central Bank, Bank of Japan, and Bank of England have coordinated quantitative easing policies since 2008. This coordination prevents the geographic arbitrage that allowed wealth preservation during previous crises. This creates a unique historical moment, the first global monetary crisis without geographic escape routes. Flight to foreign currencies is no longer flight to stability. It is choosing between different stages of the same debasement process. Precious metals are emerging not because they offer superior returns, but because they represent the only major asset class that exists outside coordinated central bank policy. Gold and silver cannot be created through monetary expansion. They cannot be devalued through policy decisions. They cannot be controlled through interest rate manipulation. Central banks understand this distinction. Their accelerating precious metals accumulation signals institutional recognition that the current system has reached its mathematical limits. They are not investing in gold. They are preparing for the next system. The institutional behavior mirrors historical precedents with disturbing precision. Roman administrators accumulated silver while publicly defending currency stability. Weimar officials converted personal wealth to foreign assets while implementing policies that destroyed citizen savings. British Treasury officials increased personal gold holdings while maintaining public confidence in sterling. Current central bank actions follow this same pattern of private preparation coupled with public reassurance. Central banks operate within an impossible triangle. They must maintain currency stability, support economic growth through credit expansion, and preserve institutional credibility. Monetary policy tools can address any two of these requirements, but never all three simultaneously. Low interest rates support growth, but destabilize currency values through capital flight and inflation. High interest rates preserve currency strength, but contract economic activity through reduced lending and investment. Moderate rates fail to address either growth or stability adequately, leading to stagflation scenarios that destroy institutional credibility. This is not a temporary policy challenge. This is a structural limitation of debt-based monetary systems. Every unit of currency is created through debt issuance, requiring interest payments that exceed the principal amount. This creates a mathematical requirement for continuous growth in the money supply to service existing obligations. The system functions as long as economic growth exceeds debt service requirements. When this relationship inverts, when debt obligations grow faster than productive capacity, the system enters terminal stress. Central banks must choose between preserving the currency and preserving the economic system. History demonstrates they consistently choose monetary expansion. Current debt to GDP ratios in developed economies indicate this inversion has already occurred. The United States requires 3 to 4% annual GDP growth to service debt obligations without monetary expansion. Actual growth has averaged 2.1% since 2010. The gap is filled through quantitative easing and deficit spending, which increases future debt obligations. Europe faces more severe constraints. Several European Union members require 5 to 6% annual growth to service debt without monetary expansion. Actual growth has averaged 1.3% since 2010. The European Central Bank has maintained negative interest rates since 2014, indicating recognition that traditional monetary policy has lost effectiveness. Japan represents the terminal stage of this process. The Bank of Japan owns 50% of the Japanese government bond market through quantitative easing. Interest rates have been near zero for 25 years. Government debt exceeds 250% of GDP. The system persists only through continuous monetary expansion and the assumption that growth will eventually resume. Precious metals serve as pressure release valves during this process. As currency credibility deteriorates, economic actors gradually shift from debt-based assets to tangible alternatives. This shift accelerates as central bank policy options narrow, creating self-reinforcing cycles that ultimately force complete monetary reset. 3 persistent misconceptions obscure the actual role of precious metals during monetary crises. First, gold and silver always increase in value during crises. This assumes precious metals are investments seeking returns, rather than refugees from systemic risk. Historical data shows precious metals often underperform during early stages of monetary crisis when central bank intervention maintains artificial stability. Significant appreciation occurs only during late-stage collapse, when confidence breaks completely. During the early stages of Weimar inflation, gold actually declined relative to other assets, as citizens believed the monetary expansion was temporary. Only when inflation reached hyperinflationary levels did precious metals begin outperforming. The majority of wealth preservation occurred through avoiding loss rather than generating gains. Similarly, during the 1970s stagflation period, gold underperformed stocks and real estate for several years while inflation was building. The preservation of purchasing power became apparent only in retrospective analysis after the crisis had concluded. Second, central banks can control precious metals markets indefinitely. This assumes unlimited policy tools and unlimited credibility. Central banks can influence precious metals prices through futures markets and coordinated selling, but they cannot eliminate the underlying demand for alternatives to their currency systems. Every intervention consumes credibility, reserves that cannot be replenished through policy action. The London Gold Pool, operated from 1961-1968 by central banks to suppress gold prices, demonstrates these limitations. Despite coordinated intervention by 8 central banks and over 3,000 tons of gold sales, the pool ultimately failed when underlying demand exceeded available supply. The failure forced abandonment of the Bretton Woods system and led to higher gold prices than would have existed without intervention. Third, modern monetary systems are different from historical precedents. This assumes contemporary technology and institutions have solved fundamental mathematical problems that destroyed previous systems. The debt-to-productivity ratio remains the binding constraint regardless of technological advancement. Digital currencies, algorithmic trading, and global coordination change the speed and scale of monetary crisis, but not the underlying dynamics. The assumption that digital systems can transcend mathematical limits represents the same thinking that led to previous monetary crises. Roman administrators believed their engineering capabilities could support infinite territorial expansion. Weimar economists believed modern industrial capacity could service unlimited reparations. British officials believed imperial trade networks could support unlimited currency creation. These illusions persist because they serve institutional interests. Financial media depends on advertising from investment firms selling complex financial products. Academic economics receives funding from institutions committed to current monetary arrangements. Government officials require public confidence to maintain political legitimacy. Understanding precious metals as crisis signals rather than investment opportunities cuts through these institutional biases toward objective analysis of system behavior. Precious metals do not emerge during monetary crises because they are superior investments. They emerge because they are the only major asset class that exists independently of failing confidence systems. When Roman citizens hoarded pre-debasement silver, they were not speculating on precious metals appreciation. They were preserving purchasing power outside a deteriorating monetary framework. When Weimar Germans converted marks to gold, they were not investing in commodity returns. They were escaping systematic currency destruction. When British subjects bought gold before sterling devaluation, they were not trading for profit. They were preserving wealth outside a system they recognized was failing. Today's central bank precious metals accumulation follows identical logic. Institutional policymakers understand the mathematical constraints their systems face. They understand that current debt levels require either sustained economic growth exceeding historical precedents or eventual monetary reset. They understand that precious metals provide insurance against both scenarios. This analysis leads to a single, unavoidable conclusion. Precious metals are not assets that perform well during monetary crises. They are the assets that survive monetary crises. The distinction is fundamental. System signals indicate we are approaching another historical inflection point. The mechanics remain identical to previous cycles. The scale is unprecedented. The outcome follows mathematical certainty rather than policy preference. Central bank precious metals accumulation represents institutional acknowledgement of these realities. The guardians of fiat money are hedging against their own system because they understand its limitations better than public statements suggest. Precious metals are not rising. Currency confidence is falling. Gold and silver merely reflect this reality with mathematical precision. The system has spoken. The signal is clear. The pattern continues.